wished for an investment that offer the best of both the worlds, the safety of debt and the upside of equity? Well, hybrid security might just be what you are looking for. Let's break it down. So if we look at the pros and cons, on the left hand side we have the pros, right, of hybrid security. First pros is higher yield. So unlike traditional debt instrument, hybrid offer better return, making your investment journey more rewarding. And it is less volatile, which means these instrument tends to have a stable price thanks to the predictable return, right? They have a stable price. Why? Because returns are predictable, which means less stress during market swing. Market swings upward and downward, so you have to take less stress during that. Then risk diversification, this is the magic. They blend equity and debt feature, right? That is why they are called hybrid, right? Why they are called hybrid? Because they blend the equity and debt feature, right, helping reduce overall risk and balancing your portfolio smartly, right? So that is called risk diversification. Then on the other side we have the cons, demerits. So first demerit is complex assessment. So evaluating hybrid security is not always easy. Their return structure can be tricky, making decision more complicated. Now, regulatory uncertainty, they are also prone to regulatory changes which might impact investment stability, a risk that every investor must consider. And finally we have limited liquidity, right? I think it is written here. Yes, limited liquidity is the next point, third point. So limited liquidity is one of the cons. So it says that so basically that if applicable, basically sometimes trading hybrid may not be as smooth as equity or bond, right? That is called limited liquidity. So these are the three demerits: complex assessment, regulatory uncertainty and limited liquidity. And pros, I have told you: higher yield, less volatile and risk diversification. So pros and cons are most frequently asked. So final thought is that hybrid security are like a power combo, exciting yet complex, right? Before jumping in, make sure to weigh the pros and cons carefully and match them with your investment goal, right? Because before you're starting investment, you must know the pros and cons of every investment portfolio that you have. Now friends, let's switch our focus to the understanding hybrid security and preference share. So friends, have you ever wondered what sits right between share and bond? Meet the financial chameleon that is called hybrid security, a perfect mix of debt and equity. So let's first zoom on the preference share. Let's see the preference share capital on the left hand side. Now friends, steady income if declared, we can call it. First of all, what makes preference share special? Preference share capital is one of the most well known hybrid security. What make them special? Let's see. First of all, dividend right. They get dividend before common shareholder. That is why the word preference is used, right? A steady income if declared. Now the second is called cumulative versus non-cumulative share. If a company misses dividend, cumulative share carry it forward. If it is non-cumulative, you lose it, right? Then we have no legal enforcement of dividend. Even with right, companies are not bound to pay. Only if they make profit and declare it, they are bound to pay. That is called no legal enforcement of dividend, right? So rights are there, but company are not legally bound to pay. Only if they make profit and declare it, right? So there is no legal enforcement of dividend. Dividend right is there before common shareholder. If a company misses dividend, then cumulative share carry it forward. That is a unique feature of this preference share. Next, have liquidation priority. Yes, if the company shut down, preference shareholder are paid before equity holder, but after debt holder. Then we have credit rating of preference share. So they can have a credit rating, helping investor assess the risk just like a loan or a bond. Then multiple classes possible. So company can issue different types of preference share with varying terms. Voting right, yes, usually no vote, but in a special case they get a say, especially if dividend are missed repeatedly. If dividend are missed for last 2 years, try to understand. If dividend is missing for 2 years, their company is not providing the dividend for 2 years, then the preference shareholder have a say in the company. And finally we have maturity option. Some are perpetual, which means no expiry, or the redeemable after a set period. We will understand it. So all these things are the peculiarities of the preference share capital. Now friends, let's look at some of the common type of hybrid security. So first of all, preference share, which means fixed dividend, priority treatment. Warrant, so give the right to buy share in future at a fixed price. So warrant give you the right that you can buy the share, right, in future at a fixed price. Then we have convertible debenture. So what is convertible debenture? So start as a loan but can turn into equity. FCCB, foreign currency convertible bond. So like convertible but issues in foreign currency. And mezzanine financing, a high risk, high return instrument, part debt, part equity, often used by growing company. In simple word, hybrid security are like financial discs. They borrow the best flavor of both equity and debt. They give fixed return like a loan, but also come with equity style feature like convertibility and priority. So question may be asked, which of the following is not a type of hybrid security? Some option will be given, and you must know that what are the types of hybrid security, then only you can answer it. So that is the peculiarity of this crash course, that we provide you every content in the simple word, right? So that at the time of revision you just go through these keywords and everything will be in your mind, right? So friends, let's move forward to the next topic, that is understanding preference share capital. Some more points are there. So let's take a closer look at the preference share capital, right? Which is a smart blend of safety and priority in the world of investment. So the first section is section number 43, right? Where, so what exactly is preference share capital? You can think of this like a special type of share that gives its holder two big advantage. First advantage is first preference, right, when it comes to receiving dividend, and second is first in line to get their money back if the company shut down. So basically two advantage it provides to the holder: first preference when it comes to receiving dividend, and first in line to get their money back if the company shut down. Even if extra dividend or leftover fund are available after winding up, these shareholders still get priority over the other. That is why they are called preference share, right? First of all, they get the first preference when it comes to receiving dividend, and they are first in line to get their money back if company shut down. Then we have section number 47, that is called voting right on non-payment of dividend. I told you that normally preference shareholder don't get to vote in the company matter, but here is the twist: if company does not pay dividend for 2 consecutive year or more, this shareholder gain the right to vote on all company decision. So remember, 2 year, if dividend is unpaid for 2 consecutive year or more, the shareholder gains the right to vote on all company decision. So in simple word, no dividend for 2+ year, full voting power unlocked. Then section number 55, that is issue and redemption of preference share. So what it means, see, let's talk about these shares are issued and taken back, that is redeemed. The key rule to remember is that irredeemable share are not allowed, which means all preference share must have a way to be paid back, right? Maximum duration is 20 year, but for infrastructure project, share can go beyond 20 year, right? If a part is paid back, you can see, if a part is paid back every year, the first condition, if the part is paid back every year; second condition, if the shareholder agree; and third condition, if their specific terms and condition are clearly mentioned. So maximum duration is 20 year, but for infrastructure project it can go beyond 20 year if these 3 conditions are fulfilled. So these are 3 sections. I'm again zooming out. So first one is 43 regarding the definition, section 47 regarding the voting right, and section 55. So you must remember the section name also. Sometimes question may be asked, which of the following is related to the voting right? Option number A, section 43. Option number B, section 47. Option number C, section 55. So 43, 47, 55. This must be known to you, because what I'm telling you, because I have observed the question have been asked in the previous year. That is why I mention here. Take it for granted. Whatever thing is presented in the form of crash course everything has been asked, right? That is why it is here. That is why it make a place in here, right? So friends, if you want such kind of content where you can easily revise the content in just 20 minutes, entire unit, you can go for our crash course. And our main motive is that you should practice more and more questions, which I add daily in our folder, and less time should be given to theory reading and the videos, because at this moment the main thing is practice. The more you practice, the more easy it become. And how you can practice? Once your theory is clear, then only you can practice. So theory, minimum theory, maximum practice. That should be our motto. Now friends, let's move forward and let's see the types of preference share. Preference share are further classified. So not all preference share are created equal. Let's explore the different types of preference share, each with its own unique twist, right? First of all, convertible versus non-convertible. So as the name suggests, this share come with a superpower that they can convert into equity share later as per the terms mentioned in the time of issue. You can think of it like a ticket that let you switch team from investor to the part owner. Then we have non-convertible. That means, as the name say, no switching is allowed. They stay as preference share forever. This is the default type issued by most company. Then cumulative versus non-cumulative. Cumulative, they offer fixed dividend. And here is the best part: if suppose the company is skip paying it in 1 year, it accumulate and must be paid later. It is great for long-term believer. Cumulative. What is non-cumulative? Non-cumulative, what happened? That fixed dividend here also, but no carry forward. Dividend will not be carried forward. If the company skip payment 1 year, that dividend is gone forever. Then participating versus non-participating. See, participating means what? You get your fixed dividend, and if the company has any extra profit, you also get a slice of that surplus. So it is a win-win situation. And non-participating means what? Here you get only the fixed dividend. Even if the company make bumper profit, you don't get a penny more. Simple and straightforward. Then we have redeemable versus non-redeemable. So redeemable means what? This comes with an expiry date. The company will buy them back after a fixed period. Some haven't come with a call option, letting the company redeem them early. And non-redeemable means what? That they cannot be bought back. Fun fact is that this is prohibited in India. Company here must specify a redemption plan. And finally, adjustable rate preference here. Here the dividend rate is not fixed. It moves with the market rate, offering more flexibility. You can think of it like a floating interest loan. It adjusts with the time. So from fixed to flexible, convertible to cumulative, preference here offer a whole buffet of choice to suit every investor appetite. So smart investors don't just invest. They choose the type that fit their strategy best. Right. So once you know all the peculiarities of all this, then only you can invest. So that is the main thing, right? You must know everything, that convertible, non-convertible, what is the difference. Every aspect should be clear. Now friends, let's shift our focus to the next topic, that is PNCPS feature. Friends, if this video adding value to your knowledge, please hit that like button, right? This will motivate me to make more such and such content. Now friends, have you ever heard of PNCPS? These are not your regular preference here. Let's decode the feature of perpetual non-cumulative preference here, or simply PNCPS, a smart tool used by bank to boost their capital strength. So first of all, let's talk about the purpose. So PNCPS are issued by Indian bank as a part of their AT1. AT1, additional tier 1 capital. In simple word, it is a way for bank to raise long-term fund without increasing debt. Right? It is a way for bank to raise long-term fund without increasing the debt. That is called, AT1 part. Additional tier 1 capital part. Then issuer and approval. Only bank can issue PNCPS, and that too with the approval from their board of director. So yes, it is not a casual call. It need official backing. Capital limit. So bank can issue PNCPS up to 1.5% of their risk weight asset in AT1. I think you know the limit. You already have learned in BFM that maximum AT1 can be 1.5 of the RWA. So that is the cap to make sure that bank don't rely too much on this instrument. Then if we talk about the future of this instrument, no maturity, no step up, no redemption. They are perpetual in nature. They live on forever. That is called perpetual. So unless the bank decide otherwise, it's like a fixed seat in the bank capital, not a short-term guest. Now friends, dividend. Dividend can be fixed or a floating, but there is a twist. The bank can cancel them if they want to, especially during tough time. So no guaranteed income here. So bank discretion is required. Bank can cancel them also. Call option. So bank can call back. Call back means redeem. So bank can call back this share, but only after 5 years, right? And with RBI green signal. So again, no random buyback. Now principal repayment. Same story. The repayment of your capital also need RBI approval, right? You can't just expect your money back anytime. Then loss absorption. So in the bad time, this share can be either converted into equity or they are written off completely. Yes, you can lose your money. That is why it is a part of AT1. It absorbs the risk, right? Then restriction. Bank can't use PNCPS to fund their own group company or related party. No sneaky moves is allowed. Claim hierarchy. If the bank goes bankrupt, PNCPS holder rank above equity holder but below creditor. So you will get paid, but only after the big lender. So to wrap it up, PNCPS, so basically this is all point we have covered regarding PNCPS. If you go through a book, it is covered in 2 pages, and in one slide everything is clear. Because all those main points have been taken at one place, and just I provided you this slide. Now, so what is the wrapping up? So PNCPS is a bold, risky but clever capital tool. It gives bank flexibility, but investor must accept that they are taking a higher risk for a potentially better reward. Obviously, they are taking higher risk here. Now friends, let's look at the Black-Scholes model. Every year warrant valuation, one question is asked based on Black-Scholes model. Ever wondered how financial analysts value complex instrument like warrant? Let me break down the legendary Black-Scholes model in the simplest way possible. You can think of it as a recipe to find the fair price of warrant. Now, first of all, the first step is to identify the key variables. So start with the ingredient. We need volatility of the stock, right? How much the price move. We need the current stock price. We need the time left until the warranty expire, We need the strike price. What is the strike price? The price at which warrant can be exercised. We need the risk-free rate, which means like government bond interest rate. So these are the building block of the formula that is called key variable. Then we calculate D1 and D2. Now we plug those variable into the Black-Scholes formula. formula to get two critical value, D1 and D2. They help us estimate the probability of making a profit from the warrant. Right, so D1 and D2 help us estimate the probability of making a profit from the warrant. Don't worry, the formula look tough, but it's just a fancy calculator behind the scene. You don't need to remember the formula, right? That's why I have not added here, right? So D1 and D2 you have to calculate. They help us estimate the probability of making a profit from the warrant. Then we find ND1 and ND2. So what it is? Something called a standard normal distribution table. So these values represent probabilities, like what are the chances that this warrant will be in profit. That is called ND1. These are like probability, you know. What are the chances that this warrant will be in profit? Now, then we calculate the present value. It's time to discount the strike price to today's value. Think of it like this. 100 rupees received a year later is worth less than rupees 100 today, obviously. So we calculate that reduced present value using math. I think you know it very well. Now then we apply the Black-Scholes formula, right? So now bring it all together. Use the full Black-Scholes formula to calculate the actual value of warrant. It blends probability, time value and volatility all in one shot. And you know, feeling lazy, let's Excel do the heavy lifting. Use function like non.dist, exp, ln. So basically using Excel the calculation is done. But what we should know that what are the steps involved. This you should know, right? So identifying key variable, right? So that's it. Black-Scholes model might look complex, but when broken down, it is just a series of smart steps to price a warrant logically and accurately. Now you know the secret sauce used by market pros, right, for valuation of warrant. So you must know what Black-Scholes model used for valuation of warrant. Now two ratios, super important. One question is fixed every year: conversion ratio and conversion price. See, so if you are confused between conversion ratio and conversion price dealing with debenture, so these are dealing with debenture, right? Let's simplify these two powerful concepts with a real world twist. So if you are holding a convertible debenture, these two numbers decide how many shares you will get and at what price. So what is conversion ratio? Imagine that you have a convertible debenture and the company promise you equity share instead of the cash at maturity. Yes, since it is convertible, so obviously that debenture can be converted into equity, and that is what company has promised you. Now conversion ratio tells you how many shares you will get for each debenture. That is called conversion ratio. Means for every one debenture how many shares you will get, right? That is what is told by conversion ratio. For example, if CR is 5, suppose conversion ratio is 5, it means one debenture gives you 5 equity share. That's it. Simple math, right? So that help you estimate your potential ownership in the company. So CR is 5, it means for one debenture we will get 5 equity share. Simple math. And what is this conversion price? Now comes the money talk. Conversion price is the effective price you are paying per share at the time of conversion. Effective price you are paying per share. So the formula is conversion price is equal to par value of the debenture, that is called face value of the debenture, and divided by conversion ratio. For example, if your debenture face value is rupees 1000 and conversion ratio is 5, so conversion price will be 1000 divided by 5, which will be rupees 200 per share. So you are getting one shares at rupees 200 each. One share costs rupees 200, no matter what the current market price is. Right, so let's wrap up. So basically conversion ratio tells you how many share you get, and conversion price tells you at what price you are getting them. So these two terms are key to evaluating whether a convertible debenture deal is worth or not. Remember it, very important. That is why it is called crash course, right? Because we are not covering everything. We are covering only thing that matters, because for everything we have separate lectures available, unit wise lecture which covers every aspect. But right now what is required, the main points that should be covered. Now friends, let's look at the ever heard of financial instrument that can act like a debt and equity. They are called hybrid instrument, and today we will decode two powerful one: FCCB and mezzanine financing. Question are every year asked. So first of all, FCCB. Imagine this as a bond, right? So FCCB, foreign currency convertible bond. So basically you can imagine this as a bond issued in foreign currency, but with a twist. It starts as a loan, that is debt, but may end as ownership, that is equity. So the definition is FCCB are hybrid security issued by the company in foreign currency. They offer interest, as you can see, coupon payment, and return the principal unless they are converted to equity. Right, they return the principal repayment. Conversion option to equity is there, right? So that is the definition. If you look at the key features of this, FCCB, that investor get the option to convert their bond into share, but conversion happen only if the market price of the stock is higher than the conversion price. See, conversion when will happen? If the market price of the stock is higher than the conversion price, right? If the stock underperform, no conversion will happen. It remained as a bond. So underperform is what? If the market price of a stock is less than the conversion price, then no conversion will be done. I think you are familiar with the conversion price. We have already talked in the previous year. Means per share, what is the price you are paying for each conversion? That is called conversion price. Now, who invest? Hedge fund, and foreign investor love this for potential upside. So investor, you can see hedge fund and foreign investor. Now if we talk about the smart option, call option is there, the issuer can redeem the bond early, and put option is there, the bondholder can demand early redemption. So both options are there, call option and put option. Then friends, if we talk about the currencies, so they are issued in a stable currency, like usually in dollar, euro. They help reduce currency volatility, and they also offer lower interest rate due to the sweetener of the conversion. And so there are some risks are there, like currency exchange rate swing, political, legal, economic uncertainty, and of course credit risk is there. What if the company fail? And terms and repayment, typically 5-year term. If not converted, the investor get the principal back. Bottom line is that FCCB combines security of debt with potential of equity, but can carry the global risk exposure, because obviously foreign exchange dealing is there. Now mezzanine financing, see, basically you can think of them like a bridge between traditional loan and fully fledged equity. On one side you have loan, traditional loan, on other side you have fully fledged equity. So they act like a bridge between them. So a hybrid instrument that give the lender the right to convert into equity, usually if the borrower default or the business condition are met. So that is called hybrid security. Means it gives the option the lender to get a right to convert to equity, usually if the borrower default. Suppose borrower defaulted, or when business conditions are met. Under these two conditions they will. What is the purpose? It is commonly used to fund large project or acquisition when traditional funding is not enough. Suppose traditional funding is not enough, right? So you want to fund a large project. In that case, mezzanine financing is great. If you look at the return and cost, so investor earn higher return than normal debt, and for company it is cheaper than equity but more expensive than regular debt. If you look at the structure, so unsecured means no collateral, fixed or variable interest rate. It is unsecured, no collateral is taken. It is fixed or variable interest rate. Both can be possible, and usually mature after the 5 years. And one thing is that the biggest advantage is that it aligns the investor interest with the company long-term success, since they can become shareholder also. So investor interest aligned with the company long-term success, right? So friends, if we wrap it up, these two, mezzanine financing and FCCB. So FCCB is foreign currency bond with conversion to equity option, and mezzanine is hybrid loan that may turn into share with high return. Both are creative financial tool that balance risk, reward and flexibility for both company as well as the investor. Now friends, let's look at the last slide, that is called Collard FRN. What if you could invest in a bond that move with the interest rate but never goes too low or too high? And what if the same bond could also react to a company credit rating? Welcome to the smart world of hybrid security, where innovative means investor need. Today we are exploring two unique types: FRN, that is called Collard FRN, Collard floating rate loan, and rate sensitive FRN. Right. So first of all, let's talk about Collard FRN. Let's rewind to 1993, where Solomon Brothers introduced a clever new product issued by Lead Permanent Building Society. What are they? So they are basically the floating rate bond, which means the interest move with the market rate. Typically LIBOR, London Interbank offered rate. So market rate changes, interest rate moves. But there is a twist. The twist is that they come with a floor and a cap. That means the floor and the cap set the boundary for the interest payout. What is the floor? Floor is 7%. What is the cap? Cap is 11%. So floor means 7% means the minimum interest you will earn. Cap 11% means maximum interest you can receive. So no matter how wild the market swing, your return stay within a safe collar. Right, that is why it is called collard. There's a collar, right? And your return will remain between the 7% and 11%. And if we talk about the currency and maturity, they were a sterling denominated with a 10-year term and a face value of 100 million euro, right? As you can see written clearly here. Now, what is the purpose of it? To protect both issuer and investor from volatile interest rate, giving stability and predictability. And behind the scene, how it works? The issuer actively use the derivative market. Right, they use the derivative market. How? They sell the cap. That means they limit the maximum payout. They buy the floor. They ensure minimum return. So this help lower the cost of issuing the bond while managing the risk effectively. In short, we can say it is like having a floating rate bond with built-in safety net. Two limits are there, floor and caps are there. So it is kind of say a floating rate bond, because interest rate keep fluctuating. And if we talk about the rate sensitive FRN, so this was a bond that adjusts its return based on the issuer credit worthiness. So issuer credit worthiness matter here a lot. It was introduced in 1988 by Hanover. The FRN offered a special spread over LIBOR. So LIBOR is there plus some spread is there. But the kicker is that the spread increased when the issuer credit rating dropped. Yes, suppose issuer credit rating drop, then a spread increase. So if the issuer become riskier, the investor was compensated with higher return. So why does this matter? Because it aligns risk and reward perfectly. The lower the issuer credit score, the more the investor earn to cover the added risk. And if you talk about the benefits of this hybrid instrument, that they help complete the market, offering new way for investor and issuer to balance risk and return. And they offer tax advantage also to some jurisdiction, and they bring in customization. But criticism also exists. Some argue that these securities were the part of supply driven craze, and bank and institutions start pushing them aggressively without truly matching investor need. So while the idea was strong, the execution got messy at time. Still there is a support. Hybrid security are these offered tailored solution, helping issuer reduce cost and investor get better return. You can easily understand and you can easily revise. So let's get started with our first topic, that it is Startup India framework, a bold step toward a new India. So look at this particular mind map. So it was launched in January 2016, as you can see, launch date. By whom? By the Department for Promotion of Industry and Internal Trade, which is called DPIIT, right? What is DPIIT? Department for Promotion of Industry and Internal Trade. And the Startup India framework marks a transformative shift in the India's economic landscape. Now if you look at the launch goal, so what was the goal of behind launching it? So to spark a revolution of entrepreneurship, to fuel innovation and drive job creation and ensure a smooth flow of investment into the economy. So these were the goal behind launching the program. Now if you look at the action plan, so here you can see the action plan. Let me zoom a little bit. So at the heart of this mission lies a comprehensive action plan built on three pillars. First one was unified policy, second is clear action point, and third is seamless execution. So these are the three pillars: unified policy, clear action plan, clear action points, and seamless execution. Now let's talk about the key features that make it stand out. So what are some key features? Here you can see the first is that incentive is disbursed online, ensuring transparency. So online incentive disbursement, thereby transparency is ensured. And startup get recognition within 72 hours. So you don't have to wait for longer. This is one of the key point, that within 72 hours, I think it is 3 days, right? So within 3 days the startup get recognized. So a startup get recognition within 72 hours, and no recommendation letter needed, just your ideas and ambition, that's it. Even a scalable business are welcomed with open arms. So you can see a scalable business are also included. So basically if you talk about the vision, if you look at the vision of this Startup India framework, so basically a thriving startup ecosystem where creativity is unlocked, the economic grows sustainably, and job opportunities are available in abundance, right? And if we talk about the platform, so all of this is brought together at one digital destination, that is called a Startup India Hub. So these are the points which we have to go through regarding this Startup India framework: launch body, launch date, key features, launch goal, action plan, and vision, right? So now friends, let's shift our focus to the next scheme that we have. It's called Startup India. So Startup India is not just a campaign, it is a powerhouse of support for every aspiring entrepreneur in India. So let's explore the rich benefit it brings to the table. The first is incubator services. So basically from day one, startup get access to startup capital access and funding avenue. They get access to the tech and lab infrastructure, mentorship and advisory and co-working space, plus unbeatable networking opportunities to fuel growth, right? So incubator services. So first of all, it includes startup capital and funding avenue, tech and lab infrastructure, mentorship, advisory and co-working space, plus unbeatable networking opportunity to fuel growth. The second is we have innovation and incubation support. See, to turn bright ideas into world-changing reality, Startup India promotes Atal Innovation Mission, right? The SETU program, global grade innovation hub, that is called world class innovation hub, and dedicated incubator setup support. So these are things included under the innovation and incubation support to turn bright idea into world changing reality. Startup India promote Atal Innovation Mission, C2 program, global great innovation hub, and incubator setup support. Then if you look at the financial benefit, here you can see financial benefit of it. So money always matter, and Startup India ensure that it is easy to manage tax incentive, capital gain tax exemption, direct government funding support, and public procurement policy priority in the public procurement. So this is financial benefits. And if you look at the regulatory restriction, So just you can see it here, regulatory restriction. So regulatory relaxation, right? So focus on your startup, not on paperwork. So self-certify under 9 labor and 3 environmental law, and enjoy inspection exemption and relax compliance norm. So this is called relaxation, regulatory relaxation. That means focus on your startup, not on paperwork. So that is some relaxation has been given so far as paperwork is concerned. Now we have IPR benefit. So IPR, intellectual property right. So protecting innovation is made simple. 80% discount on patent fee, 50% rebate on trademark, and free facilitation support, and a fast track exit option when needed. So whether you are at the ideation stage or scaling up, Startup India is your ultimate growth partner, offering tools, trust, and transformation. The 3 T's principle, right? So that is about Startup India, incubator services, financial benefit, innovation, incubation, every aspect we have talked about in this particular slide. Now we have Startup India Yatra. So what is Startup India Yatra? Let's discuss. So imagine a journey that is not just about covering miles but discovering minds. Right. So that is called Startup India Yatra. Welcome to the Startup India Yatra, a mission driven movement that bring the startup ecosystem to the remotest corner of India. If you look at the purpose of this Yatra, Startup India Yatra, so this initiative is built to discover the hidden talent across town and village. Second, to expand the startup ecosystem beyond metro cities. Third, to support grassroots entrepreneur. And fourth, to offer incubation support when it is needed the most. So these are the purpose of this Startup Yatra, Startup India Yatra, to be more precise. And if you look at the mission of it, so 2 mission is given in your book, that with the goal is to visit every district in India, and it aims to bridge the resource gap. Means connecting rural innovator with urban opportunity. Then we have the key elements. So key elements that drive the Yatra. First is mobile vans equipped with tools and mentors. Second is wide district level coverage. Third is access to incubators opportunity, and hand-on boot camp to sharpen startup skill, right? So these are key elements: mobile van coverage, incubator opportunities, and hand-on boot camps to sharpen startup skill. So from idea born in a small town to innovation that inspire the nation, Startup India Yatra is India's innovation highway, ensuring no talent goes unnoticed, right? This is called Startup India Yatra. Now then we have WING. WING is what? Women Capacity Development Program, WING, right? So friends, what happen when you give wing to your idea? You create a revolution led by women entrepreneur. So introducing WING, Women Capacity Development Program, a bold step toward creating equal opportunity in the startup world. So what is the vision of it? So as you can see, the vision is to support women-led entrepreneur, or to support women-led ventures, enhance their awareness and accessibility, and provide the right platform and training to grow. Now here we have virtual incubation. So basically a 3-month acceleration journey is specifically for 20 women-led tech startup, and in partnership with Zone Startup, all free of cost because support should not come with a price tag. So virtual incubation means 3-month acceleration journey is specifically for 20 women-led tech startup in partnership with Zone Startup, all free of cost because support should not come with price tag. Then we have the funding support. What is the meaning of funding support? See, women can apply via Startup India Hub, get screened by expert, and connect with CAIIB. I think CAIIB is right? CAIIB to explore financial assistance. Then we have workshop. So this is all funding support. So from where they get funding support, they get screened by the expert and connect with CAIIB to explore the financial assistance. And on the right side you see there are workshops that make the difference. So what does it mean? 21 powerful capacity building workshop are there. It helps across 9 states and benefiting our 1150 plus women entrepreneur. So these are the characteristics of workshop. And if you look at the online presence, so here you can see the online presence. So a dedicated page on the Startup India Hub keep everything accessible, centralized, and easy to explore, right? So this is about Wing program, Wing, right? And goal is very much clear. So Wing program is not just an initiative, it is a movement to redefine India's startup story through women-led innovation. That is called Wing program. Now let's look at the next slide that we have, that is called overview of the startup challenge. So basically, what is the meaning of a startup challenge? So Startup India is not just about ideas; it's about solving real world challenges, right? So let's look at how startup are tackling some of the most pressing issues across key sector. The first one is animal husbandry and dairy. It was launched by the Department of Animal Husbandry in collaboration with Startup India. And basically this challenge kicked off in 2019 and again in 2021 on National Milk Day in Anand, Gujarat. The goal was to find innovative tech driven solution that can revolutionize the dairy and livestock sector in India, empowering farmer and boosting productivity. That was the goal of this animal husbandry and dairy program. Then we have the Ayushman PMJY challenge, a powerful partnership between NHA, right, and Startup India under the Ayushman Bharat Jan Arogya Yojana. This challenge opened the door for startup in medical device and digital health to bring innovation directly into public health care. It's all about take meeting care to support India's largest health protection scheme. Then we have textile and garment, the innovation challenge. So Indian textile is rich in heritage and ripe for transformation. So this challenge aimed to push cutting edge innovation into one of the India's most labor intensive sector, with a global market of, you can see, 1.3 trillion, with a global market of $1.3 trillion by 2025 and domestic target of $59.3 billion by 2022. The future of fabric is smart, sustainable and startup power. So these are not just challenges, they are opportunity to build impactful, scalable solution and be a part of India's innovation revolution. Now friends, so all the content which I am sharing with you is the part of the crash course. After going through all these content, you have to solve today's MCQs and quizzes which I have added in today's folder. Now friends, let's look at the next slide. So basically we are talking about comprehensive overview of SUP challenge. So basically it is a bold initiative to reshape the future of packaging in the food and beverage industry. So what are the objective of it? As you can see, it to eliminate the single use plastic. What is the full form of SUP? Single use plastic. To promote eco design alternative and to empower F&B, that is food and beverage innovator, to create sustainable solution. So to encourage F&B, that is food and beverage innovator, to create sustainable solution, to promote eco design alternative and to eliminate single use plastic. If you look at the challenge detail, so this initiative powered by the Government of India and Startup India was launched under the banner of the SUP Challenge Goa, right? Event name SUP Challenge Goa. Startup were invited to co-develop pilot project, right? Startup were invited to co-develop pilot project with F&B partner across Goa, turning eco-friendly dream into tangible product. Now, funding and execution. So the challenge was backed by global visionary like to prevent waste alliance, Germany, ECCA Family Foundation, and execution was steered by the Incubation Network with Climate Collective Foundation as the India's partner, right? At the grassroots level, Atal Incubation Center, GIM Goa brought it all together. That is called funding and execution. So again I am repeating that challenge was backed by global visionary like Prevent Waste Alliance, ECCA Family Foundation. Execution was steered by Incubation Network with Climate Collective Foundation as the India's partner. If you look at the global participation, not just India, this movement brought in minds from India, Philippines, Thailand, Vietnam, Indonesia, with 8 entrepreneur support organizations which called ESO, right? 8 entrepreneur support organizations working across the border. This was truly a global cooperation for local impact. Now the outcome was that it bridged the gap between industries and innovator, giving rise to a scalable, eco-friendly solution that can revolutionize the way food and beverage are packed and delivered. Then the next point we have is SPRS, that is called Single Point Registration Scheme. So basically this is the entry pass to the public sector opportunity. This scheme is driven by the Ministry of MSME, right? The force behind empowering micro and small enterprise across India. If you look at the purpose of it, so the core mission is to boost government procurement from MSE, not MSME, MSE, that is micro and small enterprise, to boost the government procurement from micro and small enterprise and make it easier for them to participate in tender confidently and competitively, right? So that is the main purpose. Again I am repeating, the purpose is to boost government procurement from micro and small enterprise and make it easier for them to participate in tender. If you look at the background, the root of this scheme trace back to the government store purchase program of 1955 and 1956. And if you look at the eligibility, who can apply? First of all, MSE with UAM or EM Part 2 registration, they can apply. Second, those engaged in commercial production. Third, an even unit less than a year old can get a shot. So these are the three eligibility criteria. Alright, I just told you. Now registration validity. So the registration is valid for 2 years, but it does not stop there. It is renewable as long as the unit continue to prove its competence. So registration is valid for 2 years, and but it does not stop there. The registration is renewable as long as the unit continue to prove its competence. So this is called single point registration scheme. So with the single point registration scheme, MSME gain more than the access. They gain recognition, they gain opportunity, and they gain a seat at the national growth table. That is called SPRS. Now very important scheme, Startup India Seed Fund scheme. It could be your launch pad, but first let's check it if you are eligible to fill that dream. First of all, legal entity. What does it mean? So to begin with, your startup must be legally registered under the relevant government act. No shortcuts here. Official recognition is must. Then we have operational tenure. So you need to be more than just a name. At least 2 years of active operation is minimum bar to qualify. Infrastructure. So your startup incubator must have a minimum capacity of 25 seats, because the real ideas need real space to grow. So at least 25 seats should be there. Minimum capacity of 25 seats. And startup presence. So your incubation center should already be nurturing at least 5 active startup, right? So your incubation center should be nurturing at least 5 active startup. We are talking impact at a scale. Then we have team requirement. So strong leadership is the key. A full-time CEO with business development plus entrepreneurship experience, a support crew covering mentoring, testing, validation, finance, legal, HR. This is where vision meet execution. If you talk about the funding rule, no third party private funding is allowed for seed distribution. This ensures clarity, focus and fairness. So no third party private funding is allowed. This is very much important point, right? We are talking about Startup India Seed Fund scheme. Then we have government support clause. So basically, if you got state or central government support, that is great. If not, then ensure that minimum 3 year of operation, 2 year of audited financial, and minimum 10 physical startup under incubation. This thing you have to ensure, right? If you have got state or central government support, it is great. If not, then ensure this thing. Then we have EAC clause, that is called expert advisory committee clause. So you need to meet the extra eligibility criteria laid down by the expert advisory committee. So seed funding scheme is not just funding, it is a launch pad for India's next wave of innovation. Then we have the seed fund grant, right? So every aspect of it has been taken care of in this particular slide. So this is the heart of the process, that is called seed fund grant guideline. So first of all, incubators duties. So incubators is not just a place to sit, it is your startup powerhouse. They are responsible for infrastructure support, mentoring, capacity building, networking opportunity. So incubators don't just host, they help the build business. Then we have utilization timeline. So time is money, and here is how it is monitored. 3 year, you must utilize all of it. 2 year, at least 50% must be used. No further drawdown after deadline, so use it wisely and timely. Then we have fund use restriction. Here you can see fund use restriction. So this is only for startup funding. No infrastructure cost, no administration expense, a tiny 0.5% management fee is allowed. That's it. That is called fund use restriction. Then we have installment. So money is not handed over all at once. Here is how it is released. First installment up to 40%, and next only after milestone proof. And the best part is that funds are released within 30 days of approval. So the release time you can see within 30 days of the approval. And if you talk about the evaluation, so you can see that expert advisory committee steps in here. The expert advisory committee evaluate every proposal and approve funding on milestone based model. This is called milestone based model, meaning you grow, they release. This is not just money, it is a mission backed investment in ideas that matter, right? So if you are ready to build with purpose, track with milestone, and scale with support, right? So that is our Startup India Seed Fund Grant scheme. Then we have what? SIDV Fund of Fund scheme. Very important, right? SIDV Fund of Fund scheme. Now friends, we have what? Startup India Seed Fund scheme overview. Very important. So basically, what does this scheme aim to achieve? As you can see, objective. It was launched on 19th April 2021, and with total fund of 945 crore. Objective was proof of concept, means supporting entrepreneur to validate their idea. Product trial, which means enabling real world testing of new product. Prototype development, which means helping a startup create their first working prototype. Commercialization, which means taking product to the market. And market entry, which means helping business get a foot in the door. So it is a fully fledged support system for a startup to reach their next big milestone. And this scheme aimed to empower 3600 entrepreneur, right, entrepreneur, and collaborate with 300 incubator to drive innovation and to foster growth in the startup ecosystem. Now if you look at the structure and process, here you can see, then we have the first thing called PM announcement. So this scheme was announced by the Prime Minister himself. Then we have DPIIT management. So the scheme is managed under the Department of Promotion, Department for Promotion of Industries and Internal Trade, that is called DPIIT. Then we have expert advisory committee. So a panel of experts ensure the funds are distributed effectively. And we have the incubator role. Incubator plays a crucial role in nurturing and supporting the startup. If you look at the fund allocation, so here you can see, so 290 crore is allocated to incubator, ensuring they have the resources to support entrepreneur, and 265 startup has already been funded under the Startup India Seed Fund scheme, right? So basically government is helping entrepreneur to turn their dream into reality by using this scheme. Then we have TDF, that is called Technology Development Fund. So what it is all about, let's understand. So the primary objective of this TDF is to enhance self-sufficiency in defense technology, aiming to foster innovation and development in area crucial to India's defense capability. This fund is overseen by DRDO, this Defense Research and Development Organization, and by the Ministry of Defense, ensuring expert management and efficient use of resources. Then we have a goal. The goal is clear: to encourage both private and public industry to develop cutting edge technology that can elevate India's defense sector. The initiative is a step toward building world-class defense infrastructure and innovation. If we look at the eligibility, who can benefit from the fund, from this fund, then the first we have entities like public or private company, LLP partnership, sole proprietorship, MSME, and startups. These are the entities who can benefit from this fund. Ownership: at least 51% of the share must be owned by the Indian citizen. And location: this entity must be registered in India. Now if we talk about the funding, so the project cost, the fund cover up to 10 crore for eligible project, 10 crore for eligible project. And grant coverage is how much? The fund provide a generous 90% grant coverage for the project cost, making it a highly supportive initiative for defense technology, right? So with TDF, India is opening door to innovation, encouraging local industry to create state-of-the-art technology for defense. Then we have India Croatia Startup Challenge overview, right? So this question is also asked. So this challenge, what is basically this collaboration between India and Croatia basically aims to create impactful solution for a global challenge. And the challenge is what? A strategic partnership between India and Croatia, designed to foster innovation across multiple sectors. What are the focus area? Sustainability, which means developing green eco-friendly solution for better tomorrow. Education means so eligibility means if you are entrepreneur or if you have a startup, the challenge is for you. This challenge is for you. Basically eligible participants include registered business from both India and Croatia, and innovators who are passionate about making a difference. And this India Croatia ecosystem startup challenge encourages solution in the following key category. First we have clean water and sanitation, means tackling global water scarcity issue, reducing inequality. Left hand side what you will see the points about shared trait, and the right hand side you will see the key difference. So let's start with the shared trait first. Though different in style, but PE and VC share some common ground. Like the first point is autonomous capital, which means both tap into private fund from wealthy individual and institution. So both tap into what? Private fund. From where? From wealthy individual and institutions. Second, high incentive. Fund manager are fueled by lucrative performance based reward. That is called high incentive, right? So fund manager are fueled, they are motivated by lucrative performance based reward. Then we have pre-public investment, which means they both invest in company before they hit the public market. That is called pre-public investment. Whether it is PE, whether it is VC, they both invest in company before they hit the public market. That is called pre-public investment, right? Then Low regulation, which means that their strategies remain flexible thanks to minimal regulatory interference. And active oversight, so both demand close monitoring to drive performance and protect investment. So these are the common trait which is shared by both PE as well as the VC. So autonomous capital, let's zoom a little bit, zoom out. Autonomous capital, high incentive, pre-public investment, low regulation, and active oversight. Now if you look at the key difference between them, on the right hand side you will see the key difference. So if you look at the key difference, so on the other hand, key difference are, first of all, that is where PE and VC carve out their own path. Restructuring focus, so PE take charge of the transforming business through financial and operational restructuring. So through financial and operational restructuring, private equity takes charge of the transforming business, right? So transforming business through financial and operational restructuring. Then we have stages of investment, so VC dive into early stage startup while PE prefer matured established company. So VC, that means venture capital, invest in early stage startup. So those in startup which are at early stage, there VC dives in. And PE, that is private equity, prefer mature and established company, right? So that is on the basis of a stage of investment. This is the difference. VC invest in early stage startup while PE prefer mature established company. What about governance versus management? So PE enforce tight governance while VC nurture capable management. So PE enforce tight governance while VC, that is venture capital, nurture capable management. If you look at the debt versus equity difference, so PE often use mix of debt and equity, and VC it is all about equity, right? So PE private equity is all about mixture of debt and equity, while VC is all about equity. And that is a snapshot. Whether it is private equity or venture capital, both are power player in shaping the future of the business. So let me again go through the key points. Restructuring focus, right? Stage of investment, early stage VC investment, and PE in mature stage firm. Governance and management, just now I told you, governance versus management. PE emphasize corporate governance while VC management capability, and PE may use debt, VC primarily use equity only. So that is the difference. Now in the next slide, so ever wondered how a startup land big ticket investment from venture capital? So let us take you behind the scene of the VC funding process, right, step by step. First of all, we have something called deal origination, as you can see. So it all begin with identifying potential investment opportunity, usually through trusted network, right, referral or industry event. Then screening and shortlisting. The VC team evaluate the deal based on market potential, tech innovation, and the stage of funding. Only the most promising make it to the next round. That is called screening and shortlisting. Then we have detailed evaluation and rating. So now it gets serious. The VC, that is venture capital, digs into the founder track record, revenue forecast, and risk profile to assess long-term viability. Then we have deal negotiation. If the number and vision align, it's time to talk terms, right? Negotiating a win-win investment deal that benefit both the founder and the investor is the key. Then we have post-investment activities. So investment secured, but the work does not stop yet. VC monitor progress, offer strategic support, and often take board seat to guide the startup journey. And finally we have exit strategy, which is the ultimate goal is to maximizing the return. That could mean an IPO, acquisition, or even a buyback, whatever deliver the best outcome. That is called exit strategy. So that is the ultimate goal is to maximize the return, and that could mean an IPO, acquisition, or even a buyback, whatever deliver the best outcome. So what we have seen in this particular slide, from discovering to exit, this is how venture capital fuel innovation and build tomorrow giant. Now friends, let's look at the VC firm role and responsibility. So who is who in venture capital firm? Ever wondered how venture capital firm actually operate behind the scene? Let's break down the key player and their role in fueling the startup ecosystem. First we have the analyst. Analyst, the entry point into the VC world. These are often fresh grade or MBA intern who dive into market research and initial deal analysis. Then we have associate. After analyst, what we have? Associate. On the right hand side you can see associate, basically a setup. Associate sources deal, build founder relationship, but don't make final investment decision. They are the vital connector. They act like a connector. They build relationship, as you can see. After associate we have principal. What principal do? So principal plays a strategic role in guiding entrepreneur and contributing to the investment decision. So two keyword: investment decision, entrepreneur guidance. Think of them as decision influencer. Then we have partner. On the left hand side you can see. So partner is where the power lies. General partner make final investment call, and managing partner oversees firm operation. So basically this is where the power lie. And then we have venture partner. So these pros are deal magnet. right? So they bring in top tier opportunity and earn a share of profit without getting involved in day-to-day operation. That is called venture partner. And then we have EIR, entrepreneurship in residency. So a unique role is there. So they share a unique role, temporarily onboarding for 12 to 18 months. They are tasked with launching the next VC backed success story. And finally we have something called, limited partner, as you can see here. So limited partner, the silent but essential force. These are the fund provider, pension fund, endowment, high net worth individual who stays out of the operation but bankroll the entire search engine. So from analyst to partner, each role plays a crucial part in turning visionary startup into tomorrow unicorns, right? So that is all about this particular slide. As you can see, analyst, associate, venture partner, entrepreneur in residence, partner, principal, limited partner. So question may be asked that which of the following is a role of partner, which of the following is a role of venture partner. So you must note it down. Now friends, let's look at the next slide. So friends, here we are talking about VC fund metrics and returns. So what determine the success of venture capital fund? It's all about hitting the right target, and each one matter. So first of all, VC fund success. So the ultimate goal, the ultimate goal is to achieve the strong return for limited partner, miss the mark and the fund is considered a failure. That is called VC fund success. The ultimate goal is to achieve the strong return for the limited partner. I think we have just discussed the limited partner. They fund investor, they provide capital, not involved in operation. So basically VC fund success, how it is measured? So achieve a strong return for the limited partner because they are the one who have invested in the amount, right? Like, insurance company are the, limited partner. Hurdle rate. This question is asked, what is hurdle rate? See, this is the minimum return promised to LP. Think of it like floor. If the fund can't clear this hurdle, it is falling short. It is failing short, right? Then we have expected return. So venture capital is high risk, so naturally investor expect high reward to match. This metric keep the pressure on. Then we have sector focus. Not all industry deliver equal return. For example, SaaS, software as a service, might outperform D2C. So smart sector selection, it means a stronger return. Then we have stage focus. So investing early like in seed round means more risk but also more upside. Later stage like series B tends to be safer but with modest return, right? Now friends, so in venture capital, as you can see in this particular diagram, every arrow must be aimed with precision because only the right mix of metric leads to the winning return. Now friends, let's switch our focus to the next slide. This is the uniqueness of our crash course. Everything is presented in the form of mind map and flow chart, so that you should focus on only thing that matters from examination point of view, and your rest time should be focused on solving MCQs and case studies, which I am adding on daily basis in our crash course. If you are interested in the crash course, please see the link below in the description section. You will get the link of the course. Now friends, also we are offering 40% discount on the same. Now friends, let's talk about the private equity. That means behind the buyout. So private equity is not just about big money. It's about strategic transformation, long-term play and powerful exit. What are the pros? As you can see, pros are PE bring in alternative capital, right, with no quarterly performance pressure. First point, it gives firm breathing room to grow strategically. That is the pros. It brings in alternative capital with no quarterly performance pressure. And if we talk about the cons, so but there are trade-off. Valuation are not market driven and holding period can stretch for year, demanding patience. So pros are also there as far as private equity is concerned, that it brings in alternative capital with no quarterly performance pressure. It gives firm breathing room to grow strategically. But cons is that there are trade-off where valuations are not market driven and holding period can stretch for year, demanding patience. Now income source. Here you can see income source. So what are the income source? So PE firm earn through management fee and performance based incentive, aligning their success with the fund performance. So two types of sources are there. First is the management fee and performance based incentive, aligning their success with the fund performance. And if we talk about the funding use, so here you can see funding use, where funding will be used. So where does the money go? Into new technology, acquisition, working capital and balance sheet improvement. So fueling serious growth. And what about the exit event? So the end game, an IPO, a strategic sale or turnaround exit. These are the end game. Each move is planned to maximize investor return. And if you look at the structure of this PE, so PE firm operate with LP owning 99% with limited liability, while GP means general partner own 1% but hold full responsibility for investment. This is the structure of private equity. LP owning 99% with limited liability and GP on 1% but hold full responsibility for investment. And finally, investment sources. So I told you who fund it all. Institutional investor fund it and accredited individual fund it, which are the backbone of private equity. So friends, if you summarize this entire is this entire private equity? So we can say that private equity is about high stake strategy with equally high potential reward. It is not fast, but it is very powerful. Now friends, let's look at the types of private equity we have. Very important slide. So private equity is not one size fit all. It branches into a specialized strategy designed to target different market, different risk level and different investor goal. The first kind we have is called venture capital. So venture capital is a dynamic subtype of private equity, and this VC is driven by angel investor. It is funded by angel investor, right? And and venture capitalist. So two person funded venture, it is funded by angel investor and venture capitalist. So if we talk about the stages, it fails the early stage journey from seed, which is called prototype phase, to the series A, which we call where a startup is scale up and prepare to conquer the market. So if we talk about the stages of venture capital, it fails the early stage journey from seed to series A, right? Seed means prototype phase and series A means a startup scale up and prepare to conquer the market. So this is the stages of the stages of the journey. So early stage, seed, and series A stage. Now VC is where innovation meets capital. Venture capital is where innovation meets capital. Now the second point we have is called real estate private equity. So the second type of this private equity is called real estate private equity. So what happened, that gained massive momentum post 2008 after the real estate crash. So real estate crash post 2008, and this real estate private equity gained the massive momentum. This form target commercial real estate, CRE, REIT, and require high capital entry. That is real estate private equity. And then we have something called fund of fund, FOF. So what it happens, it is designed for those seeking exposure to private equity without direct investment. So it invests in mutual fund, hedge fund and more. It is great for a small investor but with higher fee due to its layered structure. And while diversification is a plus point, but it does not always means guaranteed return. So these are the three forms of private equity. Venture capital, right? So each type of PE serve a various different purpose, offering flexibility, which is offered by venture capital, risk variation offered by real estate private equity, and access tailored to different investor profile, fund of fund, right? So just now I told you that venture capital fuel the early stage journey, right? Sub type of private equity, real estate private equity, commercial real estate, REIT, high capital, lock-in period spans year, and fund of fund without direct investment, right? Mutual fund, hedge fund, a small investor but with higher fee. These are the key points which you must keep in mind. Now then we have legal, right? Legal and administrative structure of the private equity in India. So let's decode the regulatory backbone that shape the private equity in India. First of all, let's talk about the PE fund structure. Here we can see PE fund structure. So private equity fund in India can be structured at trust, LLP or company, but all must be SEBI AIF registered under the 2012 regulation. SEBI Alternative Investment Fund registered under the 2012 regulation. These guidelines replace the older VCF norm. It replaced the older VCF norm of 1996. PE fund are privately pooled investment vehicle with a well-defined investment policy for both Indian and foreign investor. So again I am repeating that private equity fund in India can be structured as a trust, LLP or company, but all must be SEBI AIF registered under the 2012 regulation. These guidelines replace the older VCF norm of 1996, right? And PE fund are privately pooled investment vehicle with a well-defined investment policy for both Indian and foreign investor. And one point you must note that mutual fund and collective investment scheme are excluded from this definition of PE fund structure. Then AIF category, very important. So that private equity in India operates under 3 AIF, alternative investment fund category. Category 1 AIF, it is supported by the government or the regulators. Key point, remember, supported by government or regulators. It includes angel fund, SME fund, social venture capital and infrastructure fund. These are the key points. Then we have category 2. It is PE home turf. This fund uses no leverage except for operational need and cover PE fund, real estate fund and even distressed asset fund, right? And then we have the last category 3 AIF, which is the most complex of the three, right? They use leverage and complex strategy, investing in listed, unlisted securities and derivative, and this includes hedge fund and PIPE fund, right? What is PIPE? Private investment in public equity. So basically these are the three categories. So these structure ensure that India's PE ecosystem remain flexible, regulated and open to innovation. Now then we have angel fund investment structure. Let's look at it. So friends, let's step into the world of early stage investing where innovation meets capital. What is angel fund? So here you can see the detail of the angel fund. Let me take you. So angel fund are subcategory of venture capital fund operating under category 1 AIF. I told you there are three category of AIF: category 1, category 2, category 3. So angel fund operate under category 1 AIF. They pool money from angel investor to back a startup at very early stage. So remember the key point, early stage. It is governed under chapter 3A of the CAIIB AIF regulation 2012, and these funds raise capital by issuing unit to the angel investor. Now the question is, who are these angel investors? You must know. See, they are not just wealthy individual, they are experienced professional individual with at least 2 crore in net tangible asset and relevant entrepreneur or managerial experience, corporate with net worth of 10 crore and a track record of investing, other VC or AIF entity already registered with the SEBI under VCF regulation 1996. Now, if we talk about the investment limit, minimum investment required is 25 lakh and maximum lock-in period is 3 years. Now, then we have SEBI AIF regulation. So, angel fund, operate under a standardized governance framework, just like any other private equity firm. They focus mainly on equity or equity-linked instrument or structured partnership. So, angel fund, they are the rocket fuel for tomorrow unicorn, bridging big dream with bold investment. Right, so that is the point about angel fund. So that is all you need to understand all about this particular chapter, nothing more, because only these topics have been appeared in the examination, in the last 4 examination. So I request you to please go through them, and now you go to solving machine learning. In the world of search engine, Google RankBrain start as a game changer, introduced on October 26, 2015, right? 26th October 2015 it was introduced. This powerful machine learning system transformed how search results are delivered. Initially handling less than 15% of the query, it quickly proved its strength by adapting to new queries, right? Ensuring semantic similarity and providing the most relevant result, right? So you can see launch date I have told you, and accuracy almost 90% accurate. RankBrain process is integrate and smart. It uses something called word vector. Here you can see it uses word vector, linguistic similarity, entity mapping, word cluster, user intent, ranking adjustment, user satisfaction, right? At its core, RankBrain purpose is simple. What is the purpose? The purpose is to make search result more relevant and more accurate, achieving an impressive 90% accuracy, right, rate. So accuracy rate is almost 90%. So relevancy and to make the search result more relevant and more accurate. And something called some more important point I want to tell you, that handles. So it handles unknown keywords, novel phrases, right? So handling unknown keywords and novel phrases, RankBrain prioritize the essence of a search, focusing on strong links and content for ranking. With machine learning at its heart and relevance at its mission, right? RankBrain continue to shape the future of smarter, faster and better search experiences, right? So I hope every aspect I have taken care of in this particular slide. So type I told you, machine learning, when it started I told you, accuracy I told you, and process, what are the methods which are used under the RankBrain, how much for accuracy that it has achieved. Okay, now let's look at the next point, that is AI Hub, that is called Artificial Intelligence Hub. So friends, welcome to AI Hub, a game-changing platform designed to empower developer and data scientists by providing access to top-tier machine learning expertise in a plug-and-play environment. So friends, that AI Hub primary goal is to access, reuse and exchange AI asset effortlessly. By doing so, it fosters faster innovation and reduce the redundant effort of building from scratch. At its core, AI Hub value reuses and collaboration and scalability, right? Here you can see core value, it reuses, right? It values reuse, collaboration and scalability. It offers a unified environment where developer and data scientists can collaborate and scale their project efficiently. Here you can see it offers a unified platform where developer and data scientists can collaborate and scale their project efficiently. And the content available inside AI Hub is very rich and practical. Here you can see the content available is very rich and very practical, right? From ready to use pipeline, here you can see content include from ready to use pipeline
and interactive Jupyter notebooks to robust TensorFlow modules. Everything needed to accelerate AI workflow is right at your fingertips. And some key benefits here, as you can see, some key benefits include seamless integration with Google Cloud AI, right? Leveraging cutting edge research from Google Research, and tool trusted by internal Google team themselves. When it comes to deployment, AI Hub is highly flexible, supporting both Google Cloud Platform, that is called GCP, and hybrid infrastructure. Support both of them, making it adaptable to various enterprise movement. And AI Hub also tackles critical challenges, right? AI Hub also tackles some critical challenges. What are the challenges? As you can see here, right? It likes simplifying machine learning workflow, making machine learning expertise more accessible, and behind the scene it uses powerful tool like Qflow. You might have heard about this Qflow. It uses a very powerful tool behind the scene that is called Qflow pipeline to automate, streamline, and manage the entire machine learning lifecycle. So basically, whether you are building new AI solution or scaling existing one, AI Hub start as the trusted companion, right? This AI Hub start at the trusted companion. It stands as the trusted companion for every developer, every data scientist. It is not just a resource, it is a revolution in AI collaboration and innovation. So what I have just told you, let me just give a quick overview. So plug and play environment, I told you, learning expertise in a plug and play environment. Then I told you the primary goal is to access, reuse and exchange. This is the goal part of what? Access, reuse and exchange AI asset effortlessly. And I told you core value. The core value is to reuse, collaboration and scalability. A unified environment where developer and data scientist can collaborate and scale their project efficiently. Content available is rich in practical from ready to use pipelines, interactive Jupyter notebooks, and benefits I told you: Google Cloud AI, right? Google Research, internal Google team, GCP, right? Deployment I told you that Google Cloud Platform, and hybrid infrastructure. Now friends, let's talk about Qflow pipeline. What is Qflow pipeline all about in this particular session? So in the world of machine learning, having a structured repeatable workflow is very crucial. That is where Qflow pipeline comes into picture, offering a powerful centralized platform to design and manage machine learning workflow with ease. At its core, Qflow pipeline is built around critical components. What are the components? Pre-processing, data transformation and training, ensuring that every phase of the machine learning life cycle is seamlessly handled. So these are the three phases: pre-processing, data transformation and training, right? Qflow pipeline. Now friends, its key function. What are the key function? So its key function are nothing short of game changing. It enable repeatable workflow, promote experimentation, and ensure a smooth production deployment, saving both time and resources, right? Repeatable workflow, experimentation, production deployment, and orchestration. So this capability allow developer to visually design and manage complex machine learning workflow through workflow graph, sequence execution, making even the most intricate task intuitive and efficient. This is called orchestration. It allows developer to visually design and manage complex and machine learning workflow, right? Workflow graph and sequence execution. Now Qflow pipeline true strength lies in reusability, modularity and hybrid compatibility, allowing flexible integration across various cloud and on-premises infrastructure. Strategically linked with AI Hub and Cloud AutoML, Qflow pipeline connects seamlessly with a broader ecosystem, enabling end-to-end AI solution at scale. In short, Qflow pipeline empower teams to innovate faster, automate smarter, and deploy machine learning solutions more reliably than ever before. So we have just talked about the three components of Qflow pipeline, the key function. So such kind of PDF, such kind of things will help you revise just before the examination. You will only need to go through only thing that matters. You can't. Now friends, let's switch our focus to the hybrid information system in finance. So in today's fast evolving financial landscape, innovation demands smarter, faster and more adaptive system. Enter the hybrid information system, HIS, a cutting-edge AI-driven platform designed to combine the best of multiple artificial intelligence techniques. HIS in short is called Hybrid Information System. It leverages powerful AI technique like the fuzzy expert system, neuro fuzzy system, and genetic fuzzy system. These are the AI technique. So these are the AI technique used by HIS to create solutions that are not only intelligent but also remarkably adaptive. Right. So three technique I told you: fuzzy expert system, neuro fuzzy system, genetic fuzzy system. These are the AI technique that HIS leverage to create solution, intelligent solution and remarkably adaptive solution. What is the purpose of HIS? See, purpose of HIS is simple yet profound. It blends strength of different AI model. It overcome the limitation, individual limitation. It creates systems that are more robust, reliable and versatile. This is the purpose. In the world of finance, hybrid information systems are a game changer. It is used extensively in portfolio selection and powering smart decision for financial institution. What truly set HIS apart is its competitive edge, right? Delivering a smarter product and offering more efficient service, giving organization a real advantage in a fiercely competitive market. In short, we can say that this hybrid information system, it represents a perfect synergy, merging intelligence, flexibility, strategy into the heart of modern finance. So what are the techniques which are used? Fuzzy expert system, neuro fuzzy system, genetic fuzzy system. Purpose is to blend the strength of different AI model, overcome individual limitation, and in the world of finance, HIS are a game changer. It use extensively portfolio selection and is powering a smart decision for financial institution and competitive edge. This is all about HIS, hybrid information system. Then comes neural network. Very important thing. So neural network stands at the core of today's AI revolution, offering powerful adaptive algorithm that learn and evolve without predefined model or rigid assumption. They can learn, they can evolve without predefined model or rigid assumption. So this flexibility is the key part of this neural network. This flexibility make them suitable for a wide range of use cases, from supervised learning, unsupervised learning, to handling categorical variable and solving regression problem with ease. This flexibility allow them. When it comes to practicality, neural networks shine. They excel in managing large data set, enabling simple deployment, and tackle highly complex model, making them a favorite for real world application. Their strengths are also unmatched: ability to capture complex relationship, highly adaptable structure that mold itself to the data and task at hand. Then we have their strengths are unmatched. I told you, with neural network we are not just solving problem, we are redefining how machine learn, adapt and perform. In the world driven by data, heard how business make a smarter decision, predict your next move, or recommend just the right product. All it boils down to analytics, the silent engine behind modern success. Let's break down the four powerful types of analytics that are transforming industries across the globe. The first is called descriptive analytics. So let me zoom a little bit. So this is descriptive analytics. You can think of this as a rear view mirror. It helps organization understand what happened in the past using historical data, key performance indicator and patterns. Whether it is customer behavior, marketing insight, this is where the real story begins. Then comes diagnostic analysis. On the right side you can see diagnostic analysis. Now that we know what happened, we dive deeper. Why did it happen? Diagnostic analysis get into the root cause using technique like drill down analysis, correlation, data discovery. So this is called diagnostic analysis. Then we have predictive analytics. What is predictive analytics? See, here comes the crystal ball. Predictive analytics tells us what could happen next using forecasting, a statistical model, machine learning. Whether it is predicting client behavior or future sale, this is all about staying ahead, right? So this is called predictive analytics. It tells us what could happen next using forecasting, a statistical model and machine learning. And the fourth type we have is called prescriptive analysis. Finally, the strategist of the group. Prescriptive analysis recommend what action to take, With the help of neural networks and deep learning, it suggests the best solution and strategy to optimize outcome. From understanding the past to predicting and shaping the future, analytics is not just data, it is a direction. Which type is your organization using today? Please let us know. Now friends, these are the 4 types of analytics, very important. Questions are being asked. Now behind every powerful business decision lies a set of tools that decode the data maze and turn number into knowledge. Welcome to the core component of business analytics, your roadmap to a smarter, faster decision. So first of all, we have the first core component is called the data mining. What is data mining? It all starts with discovering. So data mining means it starts with discovering hidden pattern in massive data set. So data mining, how it helps? It helps determining the hidden pattern in the massive data set. Data mining help uncover what is really going on beneath the surface, behind the surface, revealing the insight that others miss. You and me may prefer to miss, but a perfect data miner, this data mining technique will reveal the insight. Right. Then we have text mining. Not all data comes in number. Text mining extract meaning from emails, reviews, or any other written feedback, turning human language into actionable insight. Then we have data aggregation. Then comes the magic of putting it all together. Data aggregation combines data from multiple sources. Name itself suggests it combines data from multiple sources, right? And to provide a single comprehensive view, which is the foundation for accurate analysis. Then we have forecasting. Now that we have the data, let's look ahead. Forecasting uses past trend to predict what is coming next, helping business stay one step ahead. Then we have data visualization. Finally, we tell the story through visuals, chart, graph, dashboard, transform complex data into clear, compelling narrative that drive decision. So these are the part: mining, data mining, text mining, data aggregation, forecasting, data visualization. Now friends, let's see the next part, comprehensive data mining overview. So it is all about data mining. So these 5 components are the pillar of business analytics. So 5 components, just now I told you, right? These 5 components are the pillar of the business analytics, each one playing a unique role in turning raw data into revenue driven insight, right? So basically, then we have comprehensive data mining overview. Let's have a look at this particular mind map. Now friends, data is everywhere. Data is everywhere, but the real power lies in knowing how to dig deep and find what matter. Welcome to the world of data mining, the engine behind a smarter decision and sharper strategy. At the core, data mining is all about discovery, right? It's all about discovery, uncovering pattern, trend and hidden relationship within massive amount of data. If you look at that is the purpose of data mining. If you look at the technique from KDD to advanced analytics, these techniques are the tool that help business make sense of the chaos and find gold in the data mine. So techniques like KDD are used, advanced analytics are used, right? Now if we talk about the uses, whether it is real-time analytics or business intelligence, data mining add brain to the business, making insight smarter and action faster. That is the uses. Application from marketing to finance to cyber security, industries everywhere are tapping into data mining to power innovation and precision. Then we have data collection. It all begins with gathering the right data from the right sources, because what you dig up depends on where you dig. Then we have data preparation. Next comes the cleanup, formatting, filtering, polishing your data to ensure that it is ready for action. Then we have data mining execution, right? Then the real magic begin. Algorithm and model spring into action, extracting insight that fuel business breakthrough. Interpretation and analysis. Finally, we visualize. We translate number into stories, patterns, strategies. So we translate number into a story, pattern into a strategy, all with the goal of making informed, impactful decision. So data mining is not just a step in the process, it is the heartbeat of analytics. This data mining which we are talking about, it is the heartbeat of the analytics. Master it and don't just follow the trend, you predict them, right? You will able to predict the trend if you understand data mining. We have seen the purpose, technique, usage, application, data collection, preparation. Friends, likewise manner, we have prepared such kind of mind map and flowchart for each and every units of entire CAIIB syllabus. If you are interested in it, you can enroll in our crash course program, which offer you such kinds of information, such kinds of data which cover only those topic from where questions are repeatedly asked. We are not covering 100% in this crash course, rather we are focusing on only those topics from where questions are repeatedly asked, and everything is presented in this kind of flowchart mind map manner. So friends, in the description section you will get the link of the course. Now friends, let's look at the types of data mining technique. Why we are so much focused on data mining? Because questions are most frequently asked, right? Now friends, what are the types of data mining technique? Data speak volumes, right? But only if you know how to listen, and that is where data mining technique comes into play. Let's explore the toolkit that transform raw data into powerful insight. The first is called association rule. So ever noticed how buying bread often lead to buying butter? That is association rule at work. These if then statement help us find pattern, relationship, and even hidden link in the data, which is crucial for everything from market-based analysis to fraud detection. Then we have classification. When we already know the category, classification comes in to sort new data using tools like decision. So there are some tools like decision tree, CAIIB base. You can see the name here. Question may be asked that what are the tools which we use for classification. So some tools are used like CAIIB base, logistic regression, right? So these are the tools which are used for classification. Then we have clustering. What is clustering? See, clustering is all about finding natural grouping in the data. Think customer segmentation. It means grouping people by behavior or preference without any predefined level. That is called clustering. Is all about finding the natural grouping in the data, right? You can think of customer segmentation, right? Grouping people by behavior or preference without any predefined level. Then we have regression. If you want to predict something like future sale or price trend, regression model help forecast outcome by analyzing the relationship between variable, whether linear or complex. So by analyzing the relationship between the variable, you can forecast the outcome, and the regression model helps in that. Then we have sequence and path analysis. What is the meaning of sequence and path analysis? See, understanding the order of event is the key. This technique uncover how event unfold over time, helping business map customer journey or identify system failure before they happen. Then we have neural network or deep learning. So taking inspiration from the human brain, these advanced models recognize complex pattern in massive dataset. From image recognition to voice assistant, this is where artificial intelligence meet analytics. Then we have data mining software and tool. Now let's talk tools. Whether it is platform like Alteryx, Databricks, S2O.ai, right? You might have heard about it, right? Alteryx, Databricks, S2O.ai, or open source favorite like Weka and Orange. These tools simplify data preparation, modeling, and deployment, empowering business to mine site at scale. So top vendors may be asked core features, right? And open source tools are also there, and premium models are also there, right? Like NIME, DataKU, S2O.ai. So some free model are also there, premium models are also there. Now friends, text mining, the second part of it, very very important. Text mining technique, how does it work? Ever wondered how machine can understand, summarize, or even feel the meaning behind the text? Welcome to the world of text mining, where language meets logic. So friends, first of all, on the left hand side you will see text pre-processing. Before we teach machine to read, we must first clean the clutter. So pre-processing involves step like cleaning the messy character, identifying the language, tokenization. Tokenization means what? Breaking text into words. POS tagging, which means part of speech tagging, labeling word as noun, verb, etc. Chunking and syntax parsing, so that machine understand the grammar behind the message. Then we have the information retrieval. So basically, now that text is clean, let's dig out what matter. Then there comes tokenization. Tokenization is split text into token, right? It is split text into token. For what? For models. While stemming strip down word to their root, improving searching and indexing. So this is called information retrieving. Then we have something called NLP, natural language processing. So here is where the real magic happen. Summarization condenses long paragraph into key takeaway, and POS tagging add context to each word. So summarization condenses, as the name itself suggests summarization. It condenses long paragraph into key takeaway. POS tagging add context to each word. Categorization classify document by topic. And what about the sentiment analysis? Sentiment analysis, it tells us if the text is praising a product or roasting it. That is called sentiment analysis. Summarization, POS tagging, categorization, classify the document by the topic, and sentiment analysis tells us if the text is praising a product or roasting a product. Then we have information extraction. So once we know the tone, it's time to extract the value. Feature selection picks only the most important part for the analysis. That is called feature extraction. Then we have feature selection. Feature selection pick key feature for predictive model. It picks the most important part for analysis. Then feature extraction simplify the data for a smarter model. NER, what is NER? Named entity recognition. It helps detect name, places and more, bringing a structure to unstructured text. From tweets and review to research paper and chat logs, text mining transformed world into wisdom. It is not just reading, it's understanding at a scale. Now friends, let's switch our focus to the big data analytics. Very, very important topics. So every second our world generates mind-blogging amount of data. But how do we make sense of it all? That is where big data analytics steps in, turning chaos into clarity. At its core, big data analytics is all about. So I think at its core, big data is all about advanced analysis on massive, complex and diverse data set. Now, data type, it deals with every kind of data, structured like databases, semi-structured like XML file, and unstructured like email, videos, social media posts, etc. Sources, so where all this data come from? Just about from everywhere. IoT device, then mobile apps, social media platform, sensor, system log, even audio or video feed. Key characteristics. Big data is often defined by 3 V's. Volume, which means from terabyte to zettabyte. Velocity, which means data generated in real time. And variety, which means mix of format and sources. So volume, velocity and variety. Technique which is used. To harness the data, right, we use powerful tools. What are the powerful tools used? So some tools name is given here, like text and predictive analysis, data mining, statistics, natural language processing, so that even human language become data. Then we have practical uses. So you can see big data is not just about number, it drives real impact, smarter customer integration, detecting and minimizing fraud, and optimizing entire supply chain. Then we have industry benefiting, from healthcare to finance, retail to telecom. Every industry is riding the big data wave to stay ahead. In the data driven world, big data analytics is not just an advantage, it is a necessity. It is a lens that helps business see the future before it happens. That is the importance of big data. Some more slide to tell you about the importance of big data. Questions are asked based on this. So in the world flooded with data, the real game changer is how do we use it. Big data analytics is not about handling massive data set, it's about driving real business value. First of all, it helps in cost reduction. So let's start with the bottom line, cost saving. Thanks to the cloud analytics and data lake, business are dramatically cutting down on storage and operational expense. Second, we have innovation. So big data help business listen better. By understanding what customer truly need, company can innovate faster, offering product and services that feel tailor-made. Then we have faster decision. Speed is power. In memory analytics paired with IoT, allow organization to make real-time decision, turning data into action in the blink of an eye. And if you look at the impact, so big data does not just support decision, it amplify impact. From streamlining operation to boosting profit, it is a foundation of a smarter business strategy. So big data analytics is more than just a tool, right? It is the strategic edge, reducing cost, sparkling innovation, enabling decision that truly makes a difference. Now friends, let's look at the mobile web analytics components and futures. Very important topic. So in mobile first world, understanding how user interact on their smartphone is no longer optional, it is essential. Welcome to the power of mobile web analytics. Mobile web analytics tracks, first of all, what it does, it tracks everything that matters: page view, visit duration, user location, device specific detail, whether it is phone screen resolution or its model or manufacturer, everything, right? What is the purpose of it, right? So you can see now, track everything: page view, visit, device information, model, manufacturer, screen resolution. What is the purpose, the goal? If we talk about the goal of it, so the goal is to optimize user experience on mobile and supercharge your marketing effectiveness. Think of it as your digital radar, scanning user behavior to fine tune every touch point. Now what are the features that matter? Mobile analytics goes deeper than traditional web analytics. They capture nuanced device information using the user agent header and database like WURFL. So WURFL is a kind of database. So that is why we say now mobile analytics go deeper than traditional web analytics, because they capture nuanced device information using user agent header and database like WURFL, helping you understand not just who you are visiting but how. Why it is different? Unlike standard web analytics, mobile tools are tailored for the ever evolving world of smartphone and tablets, where user experience must adapt to the different device in the real time. What are the supported platform? So HTML, WordPress, PHP, Java, Python, Ruby on Rails, Node.js and Typod. So mobile web analytics integrates seamlessly with all the platform you build on. So these are the platforms: mobile analytics, futures, mobile web analytics. Friend, if you really think that this video is adding value to your information, please hit that like button. This will motivate me to make more such and such content. So with mobile web analytics, you are not just counting clicks, you are crafting experiences. Dive into the data, understand your user, and let insight lead your mobile strategy. Then we have challenges. Yes, we have seen with different business analytics technique, but obviously there are some challenges also. So friends, implementing business analytics sound promising, but the road to insight is often paved with challenges. Let's explore what truly stand in the way of success. First and foremost, analytics need a strong foundation, top leadership buy-in. Without alignment with the business strategy, even the smartest tool can fall flat. Then we have approval issues. Project can stall at the gate without clear goal and senior management approval. Analytics thrive where direction is strong and measurable. IT engagement. Yes, a successful journey demands teamwork. Collaboration between business and IT team, backed by the right infrastructure, is non-negotiable. Commitment. The initial phase often demands patience, investment and perseverance. ROI, that is called return on investment, may not come overnight, but dedication ensures long-term gain. Then we have end user involvement. Analytics should empower, not alienate. End user need to feel involved, especially when predictive model influence financial decision or require behavior change. Data integration. Today's data come in all shape and format. Bringing it together without losing meaning or value is both an art and a science. Skill shortage. Behind every powerful dashboard is a skilled professional. Unfortunately, finding the right talent, especially for a small and medium enterprise, remains a major hurdle. Storage limitation. Yes, big data need big space. A small organization often struggle to store and manage massive volume efficiently. So if you go through the book, it is covered in 2 pages. I have just refined all the key information in just 1 page so that you can easily go through it. So basically the bottom line is that overcoming this challenge require more than just tool. It takes a strategy, collaboration and a commitment to make data driven decision part of your culture. Now friends, let's look at this slide. Business analytics skill prioritization. So business analytics is not just about crunching number. It's about applying the right skill to extract insight that drives success. But how do we prioritize this skill? Let's break it down. The first is the attention to the detail. As you can see it here, attention to the detail. It is undoubtedly complex, obviously, requiring meticulousness in every step. Whether it is an essential skill for accuracy, it has limited impact on broader strategic decision, but it is a foundation on which all other skills are built. Then we have the critical thinking, second part. So critical thinking take the center stage. This skill is crucial for high impact decision. It's about analyzing data, questioning assumption, and making decisions that shape the future. If you are tackling complex challenges, this is the skill you want to prioritize. Then we have step number 3. It's called communication. So communication is straightforward. You need to articulate finding and insight clearly. While it is essential, its impact may be minimal on decision making compared to the other skill. Yet without communication, even the best insight remain hidden. Then we have the final, that is called problem solving. So this is a skill that blend impact and simplicity. It's about applying data insight to resolve issue, and although it may seem straightforward, its impact on improving operation is undeniably high. So in business analytics, mastering the right combination of skill is key. Critical thinking, problem solving leads the charge, while attention to detail and communication round out the equation, ensuring precision and clarity. So friends, that is all we need to know from this particular chapter. Thank you for listening to this lecture till now. And if you have not gone through all the previous lecture which I uploaded, the playlist of the session is provided in the description section. Please go through. Thank you.